Hi everyone, I hope you're well. Today we're going to talk about asset classes. The objective today is to present you the different types of asset classes in which you can invest to manage your portfolio. You're going to see that the main asset classes are stocks, bonds, real estate, currencies, and some other alternative investments. As always, if you like the video, please subscribe, like, it's really helping me a lot to develop this channel. All right, let's go. In order to identify the different types of asset classes in which you can invest, I'm talking about long-term investments, I decided to show you the breakdown of some pension funds, actually pension funds from Switzerland. This is a study from the bank UBS, so the Swiss bank, and this is, so in the last column over there, on the right, you can see the breakdown for all the pension funds in Switzerland. So we're going to take a look at this. Why Switzerland? Well, because they have a huge industry over there, asset management industry, and they are also world renowned for their quality of service. So that's why I decided to do that. I'm sure I could find some also good information in the US, but I have lived there, and so let's take a look. First of all, I'm going to show you the key components. If I start at the top here, this blue, so I'm sorry, it's in French, but I will explain. So this blue part here, this is real estate, okay? So it's 24%. It can be real estate in Switzerland, but also outside of Switzerland. So it's a big part, 24%. Then the second big part are the stocks. So it's divided in two parts. First of all, you have here approximately 9% of Swiss companies, okay, 9%. And in addition to that, you have stocks, but outside of Switzerland, quoted outside of Switzerland, almost 20%, okay? And the last big part are the bonds. Here also, there's two parts. First of all, bonds in Swiss francs, so denominated in Swiss francs. And then, so it's 20%, and then there's 10% of bonds denominated in a foreign currency. Okay, so if you had, bonds, stocks, and real estate, you have a big part. Here it's more than 80% of your portfolio. Okay, and in addition to that, you have some other type of classes. Obviously, you have some cash liquidity. So here it's almost 4%. It can be pure cash or very short-term bonds. And then you have some other things like, for example, you have here hedge fund. It's only 2.6% here. You have also some commodities, 1.5%. My understanding is that here it's going to be gold. And then you have here some other funds. It's private equity funds and infrastructure funds. So now I need to make some important comments. First of all, you need to understand that here the reference currency is the Swiss franc. It means that the team who is managing this portfolio is trying to maximize the return in Swiss franc. Okay, that's what it means, reference currency. Okay. Secondly, you always need to ask yourself when you're investing in something, what's really the underlying asset? Okay. And for the bonds, actually, the underlying asset is the currency in which the bond is denominated. Okay, so if you're investing in USD, basically a bond means that you're gonna get back some money in USD, the capital and the interest. Okay, so your underlying asset is the currency. But when you're talking about a stock, the underlying asset it's the activity of this company. So it's not a currency. So that's a big difference. Okay. So now if we take a look here at this portfolio, you can see that actually, for example, for the bonds, there's much more Swiss franc bonds in the portfolio than bonds denominated in a foreign currency. And the reason for that is that the underlying asset is the currency here, as I said. And so when you have a lot of bonds denominated in foreign currency, then you have a big exchange rate risk. If the Swiss franc is going up a lot compared to the other currency, then you're gonna have a big loss. Okay, so that's why they cannot increase a lot this part, the bonds denominated in foreign currency. Okay, for the stocks, it's different, because here you can see there's not a lot Swiss stocks compared to the stocks from other countries. So here there's several reasons. First of all, maybe they're not enough very good companies in Switzerland, and so they need to go and pick some other company outside of Switzerland. Okay, so that's one reason. The other reason is that when you invest in stocks outside of Switzerland, there's a lot of choice. And so you can diversify a lot your investments in companies who have revenues all over the world in different types of currency. Also, they're going to have costs in different types of currency if they have production sites in different countries. So in the end, this is going to decrease a lot your risk of foreign exchange loss. Okay, so in the end, the risk of foreign exchange loss is much higher with the bonds denominated in foreign currency compared to stocks denominated in foreign currency. So now I think we have a good overview of the different types of asset classes. And so I'm going to go now one by one and give you more details on each one. So let's start with stocks. Stocks are property rights. When you own a stock, you own some percentage of the capital of one company, and you're going to be able to get some of the wealth creation generated by this company. Okay, and there's two types of stocks that you can find. You can find listed companies. They are quoted on a stock exchange market, and you have some private equity companies when they are not listed on a stock exchange. Okay, so usually it's much harder, to find a company which is a private equity company in which you can invest. It's difficult to have the opportunity, to have the information. You need to have some contacts, some people who know how to reach these companies. And also sometimes it's difficult to invest because the minimum investment is very high, especially in the funds of private equity. Sometimes it's like hundreds of thousands of USD minimum to invest. So it can be difficult. On the contrary, for the listed company, it's much easier to invest, because you just need to open up an account. You gotta find the easiest way is to find an online broker. You open up an account, you can do everything on remote. And then you can buy directly. So there's no minimum investment. It can be just $10 if you want to buy a stock for $10. There's not, you don't have to invest that much at the beginning. But the most important part is that today you can diversify a lot with this method. Okay, you can invest in stocks from many countries, many different countries, and you can invest in many different sectors, in many different industry. So it's much more easy to create your own portfolio this way. Globally, the market size for listed companies is a little bit more than $100 trillion. So here you can see a study on this market. It's a breakdown by countries. As you can see, I mean, by far, the USA is the biggest market. It's 41%. And then after we have China, approximately 11%, and the same 11 approximately for the European Union. So now let's talk about bonds. First of all, what you need to understand is that a bond is not a property right, it's a contract signed between a lender and a borrower. Okay, and basically what it says is that there's a commitment given by the borrower to pay back in using a specific currency and following a specific schedule to pay back the capital and the interest. Okay, so that's what it means basically. So if we take the example of a fixed rate bond, then if you own this kind of bond, you're gonna know in advance exactly what are gonna be your cash flows in terms of payback of the capital and the interests. Okay, there's not gonna be any surprise in this cash flow, except in the case of a default from the borrower. Okay, but apart from this specific event, then there's not going to be any surprise. And that's why in the market, there's usually much less volatility in the bond market compared to the stock market. But as I said before, you need to be careful about the currency in which the bond is denominated. If you're investing in a bond denominated in a currency which is not your reference currency, then in this case, there's a risk to have an exchange rate loss. If the currency of this bond is going down compared to your reference currency, then you're going to have a big loss. So in this market, we have two parts. The listed bonds, this is the two parts here on the left, and non-listed bonds, okay? I call it private debt. Just to talk quickly about private debt, it's not very easy for an individual to invest in this market. There's not a lot of opportunities. So, and it's not a very big market. So I prefer to focus on the listed bonds. Okay, we have two types. Sovereign bonds. These are bonds issued by governments and bonds issued by companies. Okay, we call it corporate bonds. And for each one of them, you can invest directly, so buy directly a bond or buy some part of a fund. I must tell you that if you want to invest directly, sometimes it's difficult because there's a minimum investment, okay, which is very high, okay, it can be very high. So if you just want to invest, some thousand USD, then you should, look for a fund. In terms of market size for the listed bonds, it's a little bit bigger than the stock market. It's almost 130 trillion dollars. You can see here the breakdown by country. And again, the biggest is the US. It's 39% approximately, 19% for the European Union. And the third is China with 17%. So now let's talk about real estate. So this is actually the biggest part. The market size is a little bit more than 320 trillion. So it's a huge market. And actually within this amount, 80%, approximately 80% is the residential market. So it's a very big part within this market. So first of all, what we can say is that we're not always talking about property rights, because you can invest obviously directly in some real estate. pieces. But you can also sometimes invest in debt instruments, like for example collateralized debt. It's created by the banks. I can, for example, mortgage-backed securities. And so in this case, it's not really a title of ownership of some real estate, but it's a contract, okay? And you're gonna receive, based on this contract, you're gonna receive the repayment of the loans. So like before, you can invest directly in the real estate when you buy a house, for example, your primary or secondary residence, or when you buying a house and then you rent it out. So this is the first possibility, and the other possibility is to invest in a fund, which is afterwards invested in real estate assets. So this one, it's a good way and a very simple way, to invest in the real estate market and enable you to diversify your portfolio. In this case, usually it's going to be the underlying assets. It's going to be residential or commercial real estate. So two comments on this asset class. First of all, when you invest in real estate, you're going to have less volatility compared to the stock market. Okay, so it's going to decrease the volatility of your portfolio in average. Okay, there can be some volatility also, obviously, in the real estate market, but in average, it's going to decrease the volatility of your portfolio. And last thing I want to say is that when you own your primary or secondary residence, actually it's a kind of insurance for you, because in case of financial difficulties, it means that you have a place where you can go and live, without having to pay a rent. So I think this needs to be taken into account when you're thinking about your portfolio allocation. So what other types of assets can we find in the portfolios? So usually we call these types of assets alternative investments. Okay, so let me give you some example, the ones that we find, most of the time. So first of all, we usually find some gold, and also sometimes a little bit of silver, so precious metal. So why do we have that? Well, especially for gold, it has been used for a long time in the portfolio. So usually the idea is that gold, and it's you can verify this on the long term. It keeps its purchasing power, on the long term. And it's gonna help you usually during difficult times when there's a lot of volatility on the market. Well, it's gonna help counterbalance some losses that you have on other asset classes. That's the idea, and that's what we saw in average in the past. The other type of asset that we can find sometimes in the portfolio is hedge funds. Okay, so first of all, what you need to know is that for an individual, it's most of the time it's very difficult to buy some hedge funds. Okay, the minimum investment is very high, and usually it's only for institutional investor or professional, some professional investors. Basically, in a hedge fund, you can find any type of assets. Okay, it can be stocks, bonds, very complex products, options, many types of things. But let me give you an example. The most common hedge fund strategy is what we call long short equity. Okay, so what it means is that inside the fund there's some put options. Okay, so bets that there's going to be a decline in the market, and some call options. So basically it's bets. You bet that the market is going to rise, and so it's a 50-50 breakdown between the two. And so in the end, if the manager of the fund is right, then it should bring some additional value compared to the market. And if the market is going down or is crashing, then there should be some kind of protection. The put option will compensate the losses on the call options. So that's the idea for the hedge fund. But again, it's very difficult to buy for an individual. The next type is infrastructure funds. So this is a new type of asset which has been developing a lot over the last years. Again, it's not very easy to invest for an individual. Okay, usually it's for institutional investor, but for an individual, it may be very, very difficult. So the idea of this fund is to finance project of usually it's energy, transport, or telecommunication networks. Okay, so it's usually it's long-term, long-term projects, and that's why more and more, long-term investment manager like these products. And finally, we have the crypto assets. So for this one, it's much more easier to buy them for any individual. Very easy. So first of all, we have, of course, the Bitcoin. I think it's the strongest, if we can say. It has been created, and working for the last 13 years, I think. So now we have some history. We know it's strong. I like the fact that the infrastructure is very decentralized. I think this is a very good point. And then, apart from the Bitcoin, you have many other tokens. So for these ones, I think it's like if you're doing some very early stage investments or venture capital, something like that. It's extremely risky. There's a lot of volatility. I think it's for some of them, it's interesting because it could bring a lot of value, especially in the financial industry. So I think it's interesting. You should take a look at it. But personally, for the moment, I will not invest. I will invest only a very small percentage of my portfolio. The last asset class in your portfolio is the cash. So here we're talking about pure cash or very short-term investments for which there's going to be a very high liquidity. So for this part, it's important to, sometimes adjust the percentage in your portfolio because, for example, if you believe there's going to be a lot of opportunities, to buy other assets at a very good price, well, in this case, you should increase a little bit this part. So based on the market conditions, you should adjust the percentage. Okay, so then the question is, in which currency do you have to invest this cash? Okay, so for me, the answer is based on your reference currency. If your reference currency is a very strong currency, from country where the economy is doing well, the central bank is not printing too much money. I don't know, for example, the Swiss franc. Well, in this case, probably you will not have to diversify too much. You can invest most of your cash in Swiss francs and maybe diversify a little bit, but it's not too much. It's not necessary. On the contrary, if your reference currency is a weak currency based on your analysis compared to other currency, if it's a currency that might drop, in value compared to other currency, then you should do much more diversification, okay? And create a portfolio with your reference currency, but also other currency, which could, increase in value compared to your reference currency. So now you're probably asking yourself, what's the difference in terms of return between these different asset classes? So to answer this question, we're going to look at this analysis made by Jeremy Siegel. So it's an analysis over a very long period of time between the beginning of the 19th century through 2013. So the idea is to invest, see how it, I mean, what do we have in terms of return if we invest $1 in, so for example, dollar, gold, T-bills, corporate bonds, or stocks. Okay, and we look at the evolution over this very long period of time. Here we have on the left logarithmic scale. Okay, and so and also you should know that here we're looking at the real return. It means that it's the return after inflation. Okay, we taking out inflation to make sure that it's the real return. And here you can see that in the end, so there's a huge difference. The stocks are, are showing the biggest return, and there's a very huge difference between the stocks and the corporate bonds, for example. Here you can see that by investing $1 in the stocks, you're gonna end up with approximately $1 million, okay, in 2013. So if you compare with the corporate bonds, there's a 600-fold difference. So this is really huge. I mean, so by far, the stocks are creating more value than the other asset classes. If you look at the difference in terms of annual return, it's less impressive because here you can see for the stocks, it's a 6.7%. So it's annual real return, and it's only 3.5% real return, so annually for the corporate bonds. But in reality, so here there's not too much difference during 1 year, but actually there's a cumulative effect, okay, over a long period of time, and that's why in the end there's so much difference between the stocks and the other asset classes. So long-term performance of the stocks is the main benefit, okay, of the stocks, but there's also others. For example, direct ownership. So you can buy directly the stocks. You're the owner. It's very easy to do because you can open up easily an account online at a broker. So it's very easy to do. Also, the minimum investment to build your portfolio is very small. Actually, you can start, you don't need a lot of money to start doing this. And finally, it's very easy to diversify your portfolio. This is very important to decrease your risk. And so you can diversify easily buying stocks from other countries in many different sectors and industries. So this is, the main, I think, benefits from the stocks, and that's what I do personally. When I invest in stocks, I always do a very thorough analysis of the company, a very thorough financial analysis. I look always at valuation ratio. I try to enter only when they are extremely attractive. I'm also looking at the dividends. I like very high dividend stocks. And I also focus on small caps. Why? Because there's less competition in this market. The big institutional investor, they don't want to invest in these stocks because there's not enough liquidity for them. And so I focus on these stocks. And usually there's a lot of good opportunities, to buy at a very cheap price. Thanks for watching. If you like my videos, please subscribe, like, make some comments. This is really helping me to develop this channel. Thank you and see you soon. Bye-bye.